Welcome back, everyone. I hope you're all doing very well today, and it's been a while since I've spoken on the channel and longer since I've done something like this. So today I am going to be giving some general market thoughts in terms of where I think we are, a few hot topics, and giving my take on them. There's a lot of places where I think I could start this commentary, but where I'm going to is on the supply chain disruption. I think it has been a big lingering issue that has tentacles in a lot of different markets and has been disrupting a lot of different things. It has been a very large, rather uncommon, and far-reaching inflationary shock that has caused or exposed many inefficiencies. And honestly, the last time we've seen something sort of like this was following the 2009 recession. In 2010 and 11, there was a chip shortage. There was cargo rates going out of control. There was inflation. There was all this stuff. Why? Well, a good chunk of it was following the recession. Again, people, lack of investment caused issues and a huge surge of inflation. And guess what? Then too, the story was, money printing, Fed, inflation, whatever. So this time it's a bit different. There's people that'll say, oh, money printing is finally causing the inflation. To that, I would say, well, let's get over the supply chain issues before we jump to any long-term judgments on inflation. Now, of course, there's other things going on, and that I will get to. And that takes me to the next question, and that is inflation versus deflation. And honestly, it is so rarely one or the other, one all-encompassing thing, a time where I could say, okay, everything inflationary, everything deflationary. Because honestly, most of the time, most of the factors are mixed. And again, we have seen this inflationary surge. Is all of it going to be persistent? I think that's unlikely. Can some of it be persistent in the short term? Absolutely. But I think that when we're talking about inflation versus deflation, it's important to break it down and then important to discuss what time frame. For example, because when we're talking about inflation or deflation, there are many components and many possible time frames that we could be discussing. For example, if we're talking about autos, used car prices, well, my thinking is we're going to see a lot of deflation there. Well, that's a component. For those of you saying, yeah, but that doesn't mean anything, it's a component. Conviction on that one? Highly convinced. In the next 3 years, used car prices should be trending downwards. If there was a way to bet on that directly, I would think that the market would have, poor odds because I find it a very high likelihood. Now, if we're talking about wages over the next 3 years, well, I'd probably be in the inflationary camp. We're seeing a bit of a disruption now. That may persist, may not. Either way, I think wages are probably inflationary over 3 years. But let's talk now about energy. Let's use oil as a proxy. Well, if we're talking 3 months, I'd probably lean towards being more inflationary. Energy prices. Short term, sure, why not? It's not a high conviction trade, but I do think there's more upside potential in energy prices. But if we're talking longer term, 3 to 5 years out, there I would say I have a deflationary bias. I think that the prices are well above the cost of production and well above the price for incentivizing new production. Don't really want to get into the issue here of are they or aren't they, because to some degree they are. Enough? Well, no, perhaps not. That's why I say oil energy prices might be higher in the short term, but in the long term, I think they're going lower. So it is a discussion, and there are lots of components, and there's dozens, if not more, of these, and they all kind of stack on top of each other. But broadly, I would say most of these factors are closer to the peak or closer to the point where they would inflect and head downwards than me being someone who would at this point say, I think there's more inflation coming. I wouldn't. I think that most of the factors are peaking. What I will add about inflation is that at this point where we are now, I think inflation, while it's important to commodities and a number of markets, I think it's over discussed at this point. I think that, and yes, I know I'm just talking about it here, saying it's over discussed, get a lot of questions about it, get a lot of discussion about it, and there's a lot of theses that are based on it. And what I would say is at this point, I don't really want to, I wouldn't want to have a thesis that was based on continuing or accelerating inflation, even if I thought that was going to happen in the short term. I would say at this point, where markets are right here, I don't want to focus on it in terms of investment themes. Now that's partially because, generally speaking and broadly, I don't view the commodities themselves at this point as cheap. And I know, look at the slide. I know what I'm going to be faced with. I know people are going to say, well, but this chart shows that commodities are cheap. The nicest thing I can say about this chart is don't use it. It will probably lead to your ruin. I have stronger words that I could say about this chart, but I don't think it's relevant. You can't compare something that compounds to something that unrelated that doesn't compound. It doesn't make any sense. And the other comment that I'm sure I'll get is something in relation to money printing from that angle. And to that I will say, all indications that we have seen say that the relevance is very low. I want to be clear though, that while I'm not necessarily a bull on many of the commodities out there, and I do believe that their effective usefulness of the trade is, well, the clock has started, I'm not necessarily a bear either on some of them. I think that in some cases, the producers are not necessarily pricing in the current reality in terms of something that's going to be around forever. So there may still be decent to good returns on some of the producers if the prices can just stay in approximately the current region. They don't necessarily have to go higher to be decent investments from here. But again, it's tricky because it is a limited time trade. Now that could easily mean still 30% to 100%, depending on if we get a re-rating on some, maybe more, because that's just what the current cash flow at the current price represents in terms of their market cap. You know, and there's plenty of opportunities out there for companies to de-risk a project, prove out something, spend money in ways that are effective. But the warning would be that that won't last forever, and as that fades, you're going to have more and more sectors biased towards deflating, and that creates some of the opposite dynamics of what we've seen. So just be aware. Just a quick side comment on something I think some people are underappreciating at this point And that is, there's three key factors, and they work against each other. And that is supply, demand, and price. And all three change over time. And, so that's why I don't think you could look at just a supply story or just a demand story. I have pet peeve when someone talks about a sector that's growing when you look at supply or the investment in the sector and it's growing exponentially faster. What does that help if the sector is growing? So I think people often forget that price works in a way that smooths out the cycle in terms of, when prices are low, there's no substitution, and there's even, you can use more of something because it's cheap. When prices are high, well, you can try to substitute it out or like use less or find an alternative, stuff like that. So, they're linked. Price is linked to both supply and demand in different ways. And I think that part of it gets appreciated, part of it is rather underappreciated. So this is just a reminder and something I think that needs to be thought about more. Now look, I will freely at this point address part of the mistake I made in that I rotated out of many cyclicals too early. Now, the degree to which that was a mistake or not is dependent on which one we're talking about. But look, it was a mistake. I could have made more money if I had not rotated out as early as I did in many cases. But I still think that price-wise of where we are in the cycle, where the commodities are, I think you want to be de-risking at this point, even if the returns look very good. Okay, let's dive back briefly into Fed commentary. Yes, I think, as I pointed out earlier, I think most of the inflation is mostly transitory. What will things look like after the supply chain has been smoothed out more, after there's been a bit of time for investment to catch up? I don't think that we'll be seeing sustained inflation above 4% in the next few years. I think it will be most likely to be in the twos. Now, I know that's not necessarily a variant perception, but we're in the fives now. So, if you're thinking that it's not transitory, you're thinking what, it's fives or higher? I mean, that I don't see. So, yeah, of course, it's very complex. Of course, there's transitory is kind of meaningless because transitory could be 1 month, could be 3, could be 6, could be 2 years. I don't know. But in any case, I think that we've seen the worst of the inflation. And so in that sense, transitory could last a little bit longer. Maybe, who knows? No one knows realistically. So who knows? I don't think the Fed tapering will be a big deal. There's different talk about that at different times. I frankly think that much of it should have been done earlier, but again, they back themselves into corners by waiting too long. But it's cautious and it's a hard job, frankly. I think that they missed their shot of, we could be talking 8 years ago at this point, missed their shot of fixing their interest rates problem. They kept it too low for too long, and I think that now they've made it to a point where raising it is more problematic than ever. And honestly, for a lot of reasons, and I could discuss this in depth in a whole other video perhaps, I don't think that it's necessarily going to be helpful anymore, and probably kind of I think the ideology behind interest rate hikes is problematic. And if we do see inflation due to lack of investment, why exactly is making investment harder by raising interest rates the right move? So I don't know. I don't see it as the answer for the type of inflation we're seeing. But who knows? When people are backed into corners, they act because there's nothing left for them to do. So who knows what they do? I don't think they should raise rates. I think taper is long overdue and is much ado about very little. Evergrande. Now, this may be a bit behind the times because everyone was freaking out about it a few weeks ago, and now barely a mention of it. Not Lehman. I don't think it's Lehman, but I do think that it presents and shows some different layers of risk going forward. And so central to the risk of how this probably plays out with selling some assets and getting the bondholders made whole. I think that the central risks there are risk to property and property development in China, and I think that we've already seen that when we're looking at how the other stocks, how the other equities have been acting there. I think that's not necessarily a variant perception either. I think you could kind of look at what's going on in the market and kind of get that view. I think the secondary risk is, okay, well, let's say property is overdeveloped in China short term. Okay, so the risk there is, okay, we can't really develop much more in the near term, so there's a bit of a slowdown there, for example. Okay, so then the next risk, if that happens, is primarily the inputs. Inputs, so, steel, iron, or in China. And then the third level would be GDP sensitive things around the world. Now, as you can see, kind of as we step out, it's not directly a one-to-one impact anymore. So it's diluted every step down you go. So, if there's a big problem, could it be a hit to GDP? Yes. But there's a lot of factors, a lot of other factors in GDP and a lot of other places around the world that, might have steel demand and such like that. But third layer is, stuff like energy, different demand, global demand stories. And lastly is the contagion. So if there start seeing big hits in, prices in a number of other things, the last risk is the contagion risk. And it's interesting, actually, I wouldn't necessarily have anticipated this, but I think we started seeing that way early, the fear of contagion. And so I think that now there's enough eyes on the situation, and we kind of digested that first contagion risk, and everyone, started saying, oh, Lehman squared, Lehman cubed, Lehman whatever. So that was earlier than I expected. So that hit like a lot of things that I don't really think it should have at that point. But that type of fear, that type of seeing the hit, fear, panic type environment is a risk for a lot of things. And the problem being a lot of things that it shouldn't be, sorry. There's a lot of risk for a lot of fears in sectors that probably aren't related. And the thing I always say when people are talking about a crash is it's very hard to anticipate when people could start panicking about nothing and then stop panicking about nothing. Because to have the follow through, you kind of really need something to happen, but that's not to say that people can't panic and the markets can't fall like 10% about nothing, because they do. And so, I don't think you could really plan for that type of thing, but, it's something, the Evergrande situation is still something big that's out there, but I just don't think it is the factor. I don't think it's the Lehman, the everything imploding moment, even if it hits as hard as it may. So what has been slightly different so far this time has been when we're looking at the Capex, the spending, the bringing on more supply, in a number of issues. I think it's been interesting to witness both that there has been investment and that there's been reluctance to overinvest so far. And I think that a few reasons for that are, one is uncertainty, whether we're talking about, how long we're going to need the assets in terms of energy, if we're talking about, um, is there going to be funding in the future, ESG uncertainty, that type of thing. I think that story is out of proportion in terms of what we're seeing versus how much it's being talked about, honestly. But I do think it is playing a factor in some cases. And I think that also another thing that isn't perhaps be getting as much focus as it should is that in a number of other sectors, there's exogenous shocks that have limited ability to react. And people talk about, oh, the energy crisis, and I could talk a whole lot about energy policy, but there's also been floods in coal mines in China. That's would qualify as an exogenous shock. There's been, if we're talking about food, there's been droughts, there's been crazy weather in parts of the globe now. What are the reasons behind that? Well, there's many, but the point being, that's a shock to the system and an inflationary shock. And how much of that is, you go back a few years and you look, and I remember there was articles, coffee is trading below the price of production, 20% below the price of production. Looked at it, tried to find a way to invest in it but turns out now coffee's up 100% or something like that. And it's like, well, yeah, that was going to happen. That's what happens when prices are too low. They go up. And now it's a big deal. Now it's inflation. Now it's a whole bunch of other things. But you know what? Part of it is that. Part of it is exogenous shock. So separating what's cyclical from what's exogenous, from what's lack of capex, is a very messy story. And I honestly do not have all the answers for almost any sector, really. So that is one aspect. Another aspect is the multiple contraction of what has been slightly different this time. The multiple contraction has been intense. And in some areas that's predictable. In other areas it's more than what probably would have or should have been expected, which means that there's different capital allocation priorities. If a stock is cheap, it is probably better for the company to buy back shares rather than spend on new production. Or, if they're over levered and they kind of lucked into having a lot of debt and surviving that, and now the price goes up, well, now they pay down the debt instead of spending on new production. But that leads to what has been slightly different this time, in that there hasn't been that blow up spending that you generally see later in cycles, where the producers can seemingly no longer control themselves and spend money, take on debt at what has to be the wrong time, because broadly too much spending, and then prices implode. Now, the balance sheets in most of the sectors are far better than they have been in a long time, which is interesting. All of these are not intended as points of bullishness or bearishness. There's a bit of both in many of them. Just remarking what has seemed different. Anyway, in conclusion, I think the simple or predictable cyclical money has been made at this point. In terms of the cyclicals, risks are higher, returns are relatively lower, still possibly high, depending on how long the cycle lasts. But at this point, probably more immediate. So you've given up some of the eventual win for a win a little bit more now. And so there's still plenty of interesting opportunities out there, more risk on many of them, but I think that we're approaching the time to start looking at other things. And by that I mean something as simple as, okay, well, what has, you think about what has been the knock on things recently. Well, inflation, it could be a problem for this. Supply chain disruption could be a problem for this, that, the other thing. So you just look at, okay, what has been weighed down on by supply chain disruption? What has been weighed down on by inflation fears? Well, what happens if those start going away? What sectors can do very well? And, for similar reasons to that, I think that there's a number of sectors out there, autos, for example, that could start doing even better. And, the inventory drawdown, stuff like that. But as always, everything I say here, it's just a take, non-investment advice, and I hope you enjoyed. And until next time, have a great day.